We shall be continuing from where we stopped yesterday, speaking about the stocks compared to real estate. Today, we shall move a step further from the analogy of the stock being compared to a cake. Imagine you split this is the company as a cake. You need to divide all of these into various parts. So let's say the whole of this company is divided into 1, 2, 3, 4, 5, 6, 7, 8, 9 shares. These 9 shares we call authorized shares. So when you hear authorized shares, what it's trying to tell you is the number of shares the whole company has been divided into. Of course, when you have a very big company, you are going to be talking not just about 9 shares, but millions or possibly billions of shares. So, next, out of these 9 shares, the company then decides to only give out, say, 5. Right, so we have 5 out of this. So 5 shares to be given out and sold. So this 5 shares is called issued shares. So it means these, that, and finally these ones have been issued and sold. So people have paid for it, they have assumed ownership of it. So all these ones that have been paid for and given out is called the issued shares. Now, these shares, this remaining part, sometimes when you see a company try to look for more money for an investment, what they do is they can take out of this 6, 7, 8, 9 and sell again. So so that's principally what happens. Now, of these issued shares, we have another set called outstanding shares, and another one called treasury stocks. So what happens is when these shares are paid for fully, sometimes the company will choose to buy some of those shares that they have already issued and is paid for fully. So when they buy back those shares become treasury stocks. So when you buy back, shares, they become treasury stocks. So let's assume out of these shares they bought and let's see, they bought that 4 and 5. So 4 and 5 becomes treasury stocks. 4 and 5 becomes treasury stocks, and then the remaining 1, 2, 3 becomes the outstanding stocks, shares, whichever. Remember I told you both are just the same. So we have 1, 2, 3 being the outstanding shares, and 4, 5, 6 being the treasury stocks that the company has bought back. Moving on, we have under this one, we have what you call a share float and those which are closely held. So these ones are closely held stock. So these ones are mostly the one you can get to buy that easily. These ones are the ones that are held by the founders and those people who have not listed their shares for public trading. So let's say out of the remaining 1, 2, 3, 1 is closely held. 1 is closely held, and then 2, 3, they are the share float. So you have 2 floating shares, 2 floating shares, and 1 closely held shares. So this is how it looks like. The other key thing I need to speak about is the fact that, remember I said we have the authorized, the issued shares, the outstanding shares, and all sorts. Now, imagine a company has finished all its issued shares. What would they do? Well, let me tell you. What companies normally do is they can create new shares out of thin air to sell to the public. So all you just need is an discussion and approval by the board and all the shareholders. So normally what happens is the company is going to create a new shares by doing this to the cake. They are going to do something like that. So in that way, just like that, new shares have been added. We now have 10, 11, 12, 13, 14, 15, 16 shares altogether, of which about 7 has been created newly. Tomorrow, if they are hungry for another sale of shares, what they then do again is that. So now we have 17, 18, 19, 20, 21, 22, 23, 24 shares. Remember, we started from 9. They needed more money. They went and sold more shares. After everything has been, all the issued shares have been finished. So all they did was to change the number of authorized shares. So they changed the number, changed the total authorized shares. Anytime it's been exhausted. Simple as that. So from 9, we are here at 23 shares. Remember, each new share that is added means a new owner coming in to enjoy what you as the owner enjoyed. You see, there are companies that are very, very good at this. Without going far, let me just call a name. Shopify. Shopify. This is a Canadian company. Canadian company. If you go look at them, you see year on year they keep selling new shares, adding new shareholders and everything. What I've not bothered looking at is the fact that if they have exhausted all their authorized shares, I've not bothered to check. But all I just know is that each time the issued shares just keep going up, and up, right? So that is that. Yeah, for me, I would rather a company reinvest the earnings. Earnings is the same thing as profits. I would rather the company reinvest its profit than going to the market to buy to sell new shares all the time. Yes, that's what I would rather do. The truth is, if you know what to look for, not a lot of things to look for. If you know what to look for, you would avoid companies that abuse equity, that's selling all the time, selling new shares all the time. They see a target company they want to acquire, they just go, sell shares and then get the money and go acquire that target company. Yeah, you need to beware of this kind of company. Then another thing you need to be aware of is those that abuse debt. So it's still to either to fund their operations, or to acquire new targets, share buyback, or especially to pay dividends. Sorry if I'm moving too fast in this regard, but it's just a fallout of my discussion of the issue of authorized shares. So really, you need to watch for companies that sell shares all the time. Yeah. Continue from where we stopped. There are other terms that are associated with shares. For instance, preferred shares. Well, this is actually not a share per se. It's just a form of it's just a form of asking you to give money for a certain percentage of the value of the money that you have given, such that every year, before the owners of the company actually get dividends, you will get your percentage share. So let's assume, for instance, at the end of the financial year, the company makes, let's say, $1 million. Now, and the company decides to pay dividends. As a rule, you, who is the preferred shareholder, gets a portion of the net income before the owners actually get theirs. So that is what it is. In reality, you cannot say you are really an owner of the company. The only way you can be an owner of the company is if you have what you call ordinary shares. Let this name not deceive you. There is nothing ordinary about this. This is actually for those who own the companies. So some of these shares can become ordinary shares if they are convertible. So you can exercise ownership of the company if you, as a preferred shareholder, becomes has your shares as convertible preferred shares. So that is that. Now, talking about ownership of a company, in trying to build this factory, what normally happens is that the owners or the founders, what they do is they try to get money from themselves. They come together, get money themselves, called equity, and that equity, you are then allocated shares of that company. So you now have your ordinary shares. So those things that we talked about, authorized shares, issued shares, the outstanding, all of them are something under the ordinary shares. So, and then let's assume this factory is going to cost them $10 million. Now, within themselves, they were able to get $5 million. What they then do is for the remaining $5 million, what they would then do is they would then go for, they have different options. They then go for one, debt, and then two, they can have preferred stocks. Okay, so now, of this remaining $5 million, let's say they are able to get $3 million of debt funding at a certain percentage. Then this other one, this preferred stock, they then sell 2 million of preferred stocks. So the difference between these two is that, you see, this one, you must always pay an interest on it, and it has greater strength in terms of when it comes to liquidation. Let's say the company does not make money, and then you are forced to liquidate, close down this factory. Whatever equipment, whatever structure that this factory has would, when it's being sold, we go first into settling this $3 million, and then whatever is left will then go to those who have the preferred stocks to settle their $2 million, and then if by chance anything else is left of this liquidation, then you are talking about now giving the ordinary shareholders, the owners of this company, whatever is left of it after taking care of these people. These preferred stocks, the good thing about it is that you don't pay interest, you only pay dividends. You pay dividends. When this gets dividends, this also gets dividends. You must always give these ones dividends first, preferred in terms of they are first in line for dividends before you, the owners, can get it. But you don't pay interest on the 2 million. You can always redeem, as a company, you can always buy back this preferred stock on on the face value of it. What they get is those dividends they have gotten in the prior years, and any that is outstanding I need to clear as well. So that is what it is. Right. You see, yes, this is senior to this, and this is senior to that. In truth, if you really want to make money, this is where you need to concentrate your efforts. Ordinary shares. You buy, this is where you need to concentrate your effort. You can as well make money here, but this is really where the cream, the big money has been. Yes, this is where the big money has been. So that is that for today. Like I said, we have spoken about the different types of shares. We have spoken about the structure of raising funds for a company, and what a debt is, what preferred stocks are, and what equity is. So we are going to stop there for today. And next time we'll continue with something quite interesting as well. Thank you for watching, and remember to subscribe. We are going to really be giving you something very, very special. Thank you. Bye.